Now we are moving towards the very special part of this PowerPoint presentations. Okay, my dear students, in this slide, we are going to identify what are the available method of project evaluations. Actually speaking, there are so many methods and so many techniques available to evaluate the projects. And so these methods or these techniques can be categorized into two groups. So what are the groups that we can categorize our project evaluations techniques? The first one is a non-discounted cash flow methods. Second one is a non-discounted cash flow method. First one is discounted cash flow method. Second one is a non-discounted cash flow method, right? Or we can say first one is non-discounted cash flow method. Second one is discounted cash flow method. All is not problems, but we need to identify. There are two groups that we can categorize project evaluations method or project evaluations techniques. Okay, my dear students, look at again. So what are the methods? What are the methods that we have and how we can categorize them into the two groups? Okay, look at this one. The first one is non-discounted cash flow method. Undiscounted cash flow method. Under this non-discounted cash flow method, we can identify so many techniques. And also the second one is discounted cash flow methods. Even under this method, so we can identify so many techniques. But few of them, so we are going to discuss when this video is progressing. So we are going to discuss a few of them. Right? These non-discounted cash flow methods can be called as a traditional method also. Right? Can be called as traditional method also. This discounted cash flow methods can be called as non-traditional methods, right? Non-traditional methods. What the things explain in this particular slides? It explains that there are so many techniques available to evaluate the projects, right? These techniques can be categorized into two groups. What are the groups? First one is non-discounted cash flow method. Second one is discounted cash flow method. First one is non-discounted cash flow method. Second one is discounted cash flow method. This non-discounted cash flow methods can be called as traditional method also. And discounted cash flow methods can be called as non-traditional methods. Okay, my dear students, so move to the next slides and identify what are the techniques available under this non-discounted cash flow method. There are so many techniques available, but we are going to discuss about just only two techniques. Okay, my dear students, so now look at what are the non-discounted methods available. Actually speaking, so there are so many non-discounted available methods. There are so many non-discounted methods that can be identified. But here we are going to discuss about just only two different techniques. The first one is accounting rate of return, that is what we call ARR, and also the payback period, that is PB, right? What is the techniques that we are going to discuss under the non-discounted cash flow method? First one is accounting rate of return. Second one is payback period. Okay, look at what is this accounting rate of returns and how we can calculate accounting rate of returns and how we can take the decision based on accounting rate of returns to select the projects. Okay, my dear students, move to the next slides and look what we have. ARR indicate percentage of accounting profit against capital employed. Capital employed means how much of capital or how much of investments that we have made to acquire that particular investment opportunity. Suppose we are going to invest 1 million rupees to acquire the machines. That's 1 million, so can be identified as capital employed to calculate this accounting rate of returns. Okay, look at the next point. It's a talk about how to select the project or reject the project based on this accounting rate of return. How to select the project or what it calls reject the project based on this accounting rate of returns. Okay, my dear students, so look at it. If ARR is higher than target rate of ARR, the projects will be selected, right? Look at the point. If ARR is higher than, it should be higher than the target rate of return, the projects will be selected. This should be then, right? It should be then. That is not that. If ARR is higher than the target rate of return, the projects will be selected. Otherwise, you need to reject the projects. Okay, my dear students, look at next point. Accounting properties are treated as the returns of a project. Under these methods, capital may be initial, so average capital, right? This point is pretty much important, my dear students, and therefore I'm going to highlight it. and explain the things a bit. Okay, look at it. It's accounting profit, right? Then I talk about that there are so many project evaluations techniques available, right? Except this accounting rate of returns, all the techniques use cash flow to evaluate the project, right? Take my statements again. There are so many methods available. There are so many techniques available to evaluate the project, right? Either they are undiscounted cash flow method or discounted cash flow method. There are so many techniques available, right? Except this accounted rate of return, my dear students, all the techniques, all other techniques use cash flow to evaluate the project, right? Use cash flow to evaluate the project. That's a pretty important thing, right? Only accounted rate of return use accounting profits to evaluate the project, right? Only accounting rate of returns use accounting profits to evaluate the project. All other discounted and the non-discounted cash flow method use what you call cash flow to evaluate the project. That's a pretty important point here, right? Then so look at what is the meaning of initial capital and what is the meaning of average capital. Okay, my dear student, what is the meaning of this initial capital? Initial capital means how much you have invested to acquire the investment opportunity at the beginning, right? If we suppose we are going to purchase the machines, having incurred 1.5 million rupees, that 1.5 million can be identified as initial capital, right? Initial capital. Based on initial capital and also the average capital, we can calculate accounted rate of return. What is average capital? So, suppose, my dear students, we have purchased the machine having incurred 1.5 million rupees, right? And also we hope to use these particular machines over the period of 10 years, right? Over the period of 10 years. After the period of 10 years, the odd and ends of the machines can be sold for, say, it's 50,000 rupees. 50,000 rupees. That is what we call residual amount. Residual amount. The first we have 1.5 million initial capital. Now we have residual amount of 50,000. Together, we need to take it 5.5 million divided by 2. That is equals to the average capital. I'm talking about this point, my dear students. So look at it. This one is not at all any problems. Here you don't have any problem at all. When you are going to look at this point, my dear students, look at it. Initial capital, how to calculate initial capital is the investments that we have done initially to acquire the investments opportunity. Suppose we are going to purchase the machines having incurred 1.5 million rupees. 1.5 million rupees. What is the residual value? Suppose that particular machines is expected to use over the period of 10 years, right? After the period of 10 years, odd and ends or the remaining part of these machines can be sold for 50,000 rupees. 50,000 rupees after the useful life. This 50,000 rupees can be identified as residual value, right? This 50,000 can be identified as residual value. Residual value. Therefore, when we are going to calculate our average capital, we need to consider about initial investments and also the residual value also. We need to take the sum of initial investments and residual value that has to be divided by 2 to find out average capital. Average capital, right? Okay, my dear students. Now look at next slides, and in next slide it explains how to calculate this accounted rate of return and how to take the decision based on this accounted rate of return. Okay, go to the next slides and so look what we have. Selection criteria of ARR. Sometimes, my dear students, we have just only the one project. Suppose we have project A. We have project A. We don't have difference of project. We have just only one project, project A. How we can select that project A or reject that project A? That is the things. That's the things explained here, my students. So look at it. Look at this point. Right? It's talk about like this. ARR of the project is greater than target ARR. The project should be selected. Right? The project should be selected. I'm talking about this one. Look at it. Okay, my dear students, here we have just only one project, project A. Right? Project, when we are going to calculate project A ARR, it's a say it's a 22%. 22%. ARR of project A, 22%. Our target is 20. Our target is 20. Now what's happened? This project A can be selected to invest. Project A can be selected to invest according to this particular techniques. According to this particular technique, so we can invest because project ARR is greater than our target ARR because the project has 22% and our target is 20%. And come to this point, ARR of the project is less than target ARR. Now project has to be rejected. Suppose a project A generates only 18% accounting rate of returns. Our target is 20%. Now at 7. We can't select that project to invest. We can't select that project to invest. That has to be rejected. That has to be rejected. Suppose my students here, in this case, we have just only the one project. But when we are coming to here, we have 2 different projects or 3 different projects or more than that, more than one. Suppose here we have 2 different projects, right? Project A and project B. Project A and project B. We do not have resources to invest in both projects. We need to select just only one project based on the ARR. One project based on the ARR. Our target ARR is 25%, right? Project A generates 26% and project B generates 22%. Now, which project has to be selected? First, out of these 2 projects, we need to select the project which generate higher ARR. According to the information, according to the examples that we have taken, project A generates 26 and project B generates 24% ARR. Therefore, we have to select project A. Now, this has to be compared with our target ARR. Project A has 26%, our target is 25. Now, project A can be selected. Project A can be selected. Come to the next point. I'm talking about this one here, right? Okay, my students, so we talk about this point, right? This points has already been discussed, and so come to these points. Now, so we have 2 different projects. That's projects A and projects B. Project A generates 24%. Project B generates 23% of ARR. Our target is 20. Our target is 24%. Our target is 24%. Now, what happens to my students? So one of the project has to be selected, but neither project cannot be selected because both projects generates lesser ARR. Project generates ARR less than the target ARR. Therefore, both project has to be rejected. Both project has to be rejected here. Okay, my students, but sometimes both A and B generates ARR more than the target ARR. Suppose our target is 25%, so A generates 26, B also generates 25.5%. Now we have a problem. So whether we are going to select both or not. Both or not. Actually speaking, some of the students, if we can acquire just only the single opportunity, under such what we are going to do, we need to select the project generates higher ARR, that is project A. It generates 26% of ARR. Then we have to compare that one with the target ARR. Target ARR is 25%, so 26 is greater than the 25. Therefore, the project A only can be selected, right? Project A only can be selected. This is not right, my students. Now we are going to look how we can calculate this ARR. Actually speaking, some of my students, one important points I need to give you, unless in your examination ask, calculate ARR based on the average investments, you had better to calculate ARR based on initial investments. Again, I will repeat it, right? In your examinations, unless your paper asks to calculate ARR based on average investments, you had better to calculate ARR based on initial investments. So therefore, in this first example, so we are going to calculate ARR based on both methods, but in the coming examples, next, we are not going to calculate under 2 different methods. We are going to calculate based on the initial investments only, right? With that in mind, look at the examples. Okay, my dear students, look at it. Following information about the project say provided to you. Initial investments are 100,000 rupees, useful life 5 years, accounting profits being given. Therefore, we do not have any kind of problems because based on the accounting profits, we are going to calculate accounting rate of returns. The useful life of 5 years, and so therefore the 5-year periods of profit being given. Target rate of returns, the target is 35%. And you need to calculate ARR and also comments on selections of projects. Here we have just only the one project. We need to decide whether we are going to select the project or reject the project. How we can reject the project? Actually speaking, if we have ARR less than 35%, we have to reject the projects. Okay, look at how much of ARR that we have. Okay, my dear students, both methods been given here. According to both methods, calculations have been done. And so you can look at it. First, you need to calculate your average profit, right? First, you need to calculate your average profit. Okay, my dear students, look at it. Look at the point. Here, first, we need to calculate average profits, right? Before that, look at the formula based on the initial investment. So we can calculate ARR like this. Average of profits for the periods are divided by initial investments into 100, right? Into 100. This one also same, the average of profit here. Same things. Upper the line, right? Above the lines, we have same things. Average profits, here also average profits. But here, initial investments here, we need to take average investments. How we can calculate average investments? Initial investments are plus residual value divided by 2. In the previous slides, one of the previous slides, we have discussed about how to calculate this average investments. How to calculate this average investment, sorry. And now look at how to calculate this average profit. To calculate average profit, my dear students, you need to take the sum of profits for the period, sum of profit for the period, or you need to take the total of the profit generated for the period, right? From here, we can take that sum that has to be divided by number of years, or useful life of the projects, When you are going to divide total profits by number of years, here we have average profit of 24,000. Average profit of 24,000. You have to try, right? You have to try with the calculations. My dear students. Take the separate paper and watch this particular video, and you need to separately calculate the answers. For all and each and every questions available in these presentations. Okay, then initial investments. That's 100,000. So you can take the information from the examples. Then, this 24,000, that is average of profit for the period, divided by this 100,000 is initial investment multiplied by 100 equals to 24%. Here, in this investments opportunity or the projects A generates 24% of ARR. Therefore, this project cannot be selected, right? Therefore, this project cannot be selected because our target ARR, right? Our target ARR is 35%. So therefore, according to the initial investments, we are not in a position to select this project. So this project has to be rejected. But my dear students, when we are going to look at our average investments method, so look at it. Look at it, right? Average profit can be calculated in same fashions like here. Then the average investments, right? 100,000 initial investments. But in this example, my dear students, information related to the residual value not given. Information related to the residual value not given. So therefore, 100,000 plus 0 divided by 2 equal to the 50,000. Right here, average investments of 50,000. Average investments of 50,000 and 24,000 divided by 50,000 into 100 here. Right? It's equal to not 28%. So this should be 48%, right? This should be 48%. Check the calculations, okay? This should be 48%. 48% means it's more than the 35%. So therefore, if you are going to calculate accounted rate of returns based on average investments, this particular project can be selected, right? This particular project can be selected. This project should be selected as ARR is more than the target ARR. Two different methods gives you two different options, right? The first method, initial investments methods, reject it, and average investments methods, select it. Average investments method, select it. Don't worry about it. That's the calculations, right? That is the calculations. Okay, go to the next one. And so look at how you can calculate it. There are three different projects available, and its initial investments have been given 1,000 rupees, useful life also 5 years. The profit generated by each projects are estimated to as follows, right? Profit also being given. So same things as you need to calculate ARR for each and every project. So separate answer comments on the project. Okay, look at it. Okay, my dear students, when you're going to calculate in same fashion, so sum of the profit being taken here, right? Sum of the profit. Each and every project generates a sum of profit of 1,000 rupees each. 1,000 rupees each. Therefore, when you are going to calculate the average profit also same. Average profit also same. When you are going to look at here, my dear students, for each and every year, we have different type of profits or different amount of profits. But even though it's a difference, when you're going to take the total of profits for higher period of times, it's equal, right? It's equal each other's. For project A, sum of profits 1,000, project B also 1,000, project C also 1,000. Therefore, we have same amounts of average profit. Therefore, we have same amounts of average profit. In this case, we are going to calculate accounted rate of returns based on only initial investments, right? Only initial investments. I'm not going to talk about how to calculate this one based on the average investments. In your examinations, ask you to calculate accounted rate of returns without specifying the methods. You had better to calculate accounted rate of returns based on the initial investments. Okay, my dear students, so look at it. The first method, we have the same amounts of average profit and also the same amounts of initial capitals. Therefore, each and every method generates accounted rate of returns at 20% each. You need to calculate it again, okay? Take the piece of paper and calculate the answers for each and every question. So then you can get better understandings regarding how to calculate accounted rate of return. Not only accounted rate of returns, but also other techniques are same, so you have to practice it, right? Then look at the decisions. Every project records same amount of ARR, right? Therefore, the best project cannot be selected considering only ARR, right? Each and every project generates 20% of ARR. Therefore, whatever our target ARR, now we have a kind of the problem. So suppose my students, our target ARR is 15%, right? Neither project cannot be selected because whole project generates 20% ARR, that is more than the target ARR, but we have kind of the problems. We have a kind of the problems. So we are in the very big problems, which project should be selected. Therefore, based on only ARR, neither project cannot be selected here. Neither project cannot be selected here. To select the project or reject the project, we need to consider so many factors, right? We have to look at them. We have to look at them, so then only we can take the right decisions. Right, look at the next slide. Again, we have examples. Same things. The initial investments have been given by the students, the same amount, or rather, same length of useful life, that's 5 years. And initial investments is different, that is not a problem for us. And also the profit before tax also being given, right? Profit before tax also being given. That's also not a problem, right? Based on this one, so you can calculate accounted rate of return, right? Look at how you can calculate it. Again, my dear students, you need to take the sum of profit, right? Sum of profits, project X, we have sum of profit of, how we can calculate the sum of profit? You need to take the sum of these 5 items, right? 5 figures, so you need to take the sum, that is 160,000. Here, you need to take the sum, that is 28,000 total profit, sum of the profit. Then, this should be divided by 5. 5 means useful life. 5 means a useful lives. Then we have average profit of 32,000. In projects, rather, project A generates average profit of, project X rather generates average profit of 32,000. So project Y generate average profit of 56,000. When you're going to calculate what you call the accounted rate of returns, my students, of project X, it says 32,000 divided by these initial investments, it should be 8,000 rupees here, right? So 8,000 rupees into 100. That's 40%, right? In terms of the percentage is concerned, ARR is 40%, that is from project X, right? Project Y is concerned, that is 37%. Project Y is concerned, that is 37%. Now, which project has to be selected? Which project has to be selected? Project X should be selected as it has ARR of 40%, which is more than that of the project Y. But my students, out of this project, X can be selected because of it has better ARR than the project Y. But this 40% has to be has to be compared with the target ARR of the organization before selecting or rejecting this project X. According to the available information, it's okay that we can select this project X. Project X can be selected because it has 40% of ARR. That is more than the 37% which is generated by Y, right? Therefore, we can select project X. But my dear students, when we are going to take the real decisions, we need to look at how much of target ARR that we have. Because in the organization is concerned, organization has target ARR. Suppose target ARR is 38%. Now it's okay that we can select the project X. Suppose target ARR is 42%. Now neither project cannot be selected in this case, right? But anyway, target ARR is here not given, so therefore you can see you can select project X, right? If target ARR is not given, you need to select the projects which generates higher ARR. That's all, right? Okay, my students, so go to next one and look at advantages. These are the advantages of this method. It's easy to calculate and understand. Yes, it's easy. When you're going to look at the, when you're going to calculate what you call NPV or net present value methods, entire life of the project is considered. Yes, if lifetime is 10 years, we need to consider 10 years profit to calculate the average profit. So therefore, we have to agree with that point. Entire life of the project is considered. Entire life of the project has to be considered when you're going to calculate average profit. Yes, it's okay. Managements and investors preferred accounting profit because my students, that's most of the people like accounting profits. They look at the financial statements. If financial statement says they have this much of a net profit and this much of gross profit, people are pretty interested, right? People like accounting profits. Therefore, these techniques use accounting profits to evaluate the projects. Therefore, managements and also the investors are preferred on accounting profits. And the people who preferred on accounting the profits preferred even these methods because these methods select or reject the project based on the accounting profit, right? The profit always brings so many weaknesses, but people did not consider about it. They always like this profit. And so therefore, the people who like profit always like this accounting rate of return source. Okay, my dear students, and now look at the disadvantages. This is also clear for you. Look at it. Disadvantages. No universally accepted method to calculate ARR. It's okay because the previous time, you can remember, my dear students, even we are going to calculate ARR based on two different methods. That's initial investments and also the average investments. Two different methods produces two different methods produce two different results. Therefore, we have to take a different kind of decision based on the different method. The accepted method to calculate it or universally accepted method to calculate it. Therefore, different peoples and different scholars calculate different ratios in the different ways. That's one of the weaknesses. That's one of the weaknesses or disadvantage related to this accounting rate of returns, right? Then accounting profit is considered to evaluate the project instead cash flow. Because now, my dear students, as I said earlier, most of the techniques, I mean, that except this accounting rate of returns, all other techniques use cash flow to calculate to evaluate the projects, right? To evaluate the project, except this accounting rate of return, so all other techniques use cash flows. All other techniques use cash flows, but these techniques only use accounting profit. And also this accounting profit has so many weaknesses, right? This is not a time, sir, to discuss what are the weaknesses in accounting profit. But you need to remember in accounting profits, we have so many weaknesses. And therefore, the people who knows about these weaknesses do not like this accounting profit. The people who know about the weaknesses related to the accounting profit don't like this accounting rate of returns to evaluate the projects, right? Based on the accounting rate of returns, they don't like to evaluate the projects because they know there are so many weaknesses available in the accounting profit. Okay, my dear students, then the time value of money is not considered to evaluate the projects. You may have kind of the problems of what's the time value. And when we are going to discuss in the net present, rather, when we are going to discuss net present value methods, we can identify what is the meaning of this time value.